Your sales can double and your business can still almost go under doing it. And most owners never see it coming. Not because growth is bad, but because nobody warned them that growing too fast can quietly drain every dollar you have. So today, let's talk about why more revenue can actually make you broke and how to grow without it happening to you. Hi, I'm Janie with Sturgeon Bookkeeping. One quick note before we dig in. You'll hear me say revenue and sales, and I'm using them to mean the same thing, money coming in from your customers. You'll run into both words out in the world, so I'm going to go back and forth, but don't let that trip you up. It's the same thing. If you're a business owner, growth feels like the goal. More sales, more customers, more work coming in. And that's completely understandable to see it that way. We're taught that more revenue is always a good thing. But here's what almost no one tells you. Growth costs money before it makes you money. And if you don't see that coming, a great year can turn into a cash emergency. By the end of this video, you'll know exactly why that happens and the two numbers that tell you whether your growth is healthy or whether it's about to bite you. If you want your growth to actually strengthen your business instead of straining it, please subscribe. Now let's meet two business owners. Let's meet Ben. Ben runs a growing business. Things are taking off. Revenue is up 40% over last year. The phone is ringing, new orders are coming in, and every month is bigger than the one before. By every measure Ben can see, this is a huge success. And it should be. Growth like that is something to be proud of. So when Ben's bank account starts feeling tight, it doesn't even register as a problem at first. More revenue, so of course there'll be more money, right? Not necessarily right away. And this is the trap. Growth can feel exactly like winning right up to the moment it doesn't. The busier Ben gets, the tighter the cash gets. And Ben can't figure out why because on paper, everything looks great. Now meet Dana. Dana runs a similar business, growing at almost the same pace. But Dana's growth feels steady, not scary. Same climbing revenue, completely different feeling in the bank account. Same growth, two very different stories. The difference isn't luck and it isn't about the revenue. The difference is that one of them understood what growth actually does to your cash and the other one didn't. So let's look at what Ben was missing. Here's the part that catches so many good business owners off guard. Growing your revenue almost always costs you money before it pays you back. Let's think about what happens when the orders pick up. To do more work, you usually have to spend more first. More materials, more supplies, maybe more hours or more help. Maybe you even have to buy equipment, and all that cash goes out the door before the new work is finished, and sometimes long before the customer actually pays you. When you do more work, you send more invoices, but an invoice is not cash. You've earned the money, it's real, it's coming, but it's not in your account yet. In fact, all those invoices you've earned but haven't collected yet have a name. That's your accounts receivable, and it shows up on your balance sheet. The report that lays out everything your business owns and everything it owes as of one specific day. And the faster you grow, the more of your money gets tied up there, parked in accounts receivable, in work you've already done but haven't been paid for. Put those together and you get the trap. Growing means spending more now and waiting to get paid back. Your expenses, material, labor, equipment speed up immediately. Your cash coming in lags behind, and that gap between the money going out to grow and the money coming in from that growth is exactly where good businesses get squeezed. Businesses rarely close their door because they're too busy. They usually close their doors because they run out of cash before they get paid. That's what was happening to Ben. Every new order meant spending more up front and waiting longer to collect. The business wasn't failing, it was growing, but the business was using cash faster than customers were paying their invoices. Growing fast enough without watching your cash and how long it's taking your customers to pay you, and you can actually grow yourself right out of business. Dana saw the exact same growth, but Dana kept an eye on the receivables. And when she noticed the unpaid invoices starting to pile up, she tightened up on how she collected, following up faster, getting paid sooner, before it ever became a problem. Same growth as Ben, she just watched the right number. Here's what makes this so sneaky and why Ben didn't catch it sooner. Through all of this, Ben looked at his income statement. The report that shows you your revenue at the top and what's left over, your net profit, at the bottom. And that net profit number looked great. The business was profitable. So how can a profitable, growing business be running out of money? Because profit does not equal cash. Your profit can be climbing right alongside your revenue, while the actual cash in your account is heading the other direction. Because your customers haven't paid you yet, but you've already spent the money to do the work. Profit is on paper. It's what's left over once your business counts everything it costs to earn that revenue. Cash is what you actually have in your bank account on any given day. And during fast growth, those two numbers can point in completely opposite directions. Here's what that looks like in real life. Say you finish a $20,000 job in December. That's $20,000 of profit on your books right away. But if the customer doesn't pay until January, the cash doesn't show up until then either. Your profit already counted it. Your bank account is still waiting. That's the whole reason growth is so dangerous when you're not watching for it. The one number most owners check, the net profit on their income statement, looks great. It reassures you. Meanwhile, the number that's actually keeping your doors open, the cash in the bank, is quietly draining, and nothing on that profit line is warning you. Take Ben's actual numbers, $40,000 in net profit, right there on his income statement. $1,200 in the bank. On paper, everything looked great. In reality, he was one bad week away from not being able to cover his own bills. Dana understood this. Dana knew that a big revenue month and a healthy bank account aren't always the same thing. So Dana kept an eye on both. Ben wasn't doing anything wrong. He probably checked his bank account all the time. Nobody had ever shown him what he was actually supposed to be looking for when he did. And that's the real difference. Not that one owner checked their bank account and the other one didn't, but one knew what pattern to watch for and the other one didn't. So how do you make sure you're watching for that pattern too? It comes down to two numbers. Here's how you grow on purpose instead of by accident. Two things to watch. The first one is your net profit, the bottom line of your income statement. Is that actually growing along with your revenue? Here's what that looks like in real terms. Say your revenue climbs 40% this year, but the profit at the bottom of your income statement, that looks about the same as it did last year. That's a warning sign. Your revenue grew, but almost none of that turned into profit. And that gap is telling you something. Your expenses might be taking too much of your revenue, leaving you with little to actually grow with. Maybe your prices haven't kept up with your costs. Maybe the expense of doing all that extra work is eating the gains. Or maybe the cost of just keeping the business running, your rent, your overhead, your day-to-day expenses has crept up as you've grown. Healthy growth usually means your net profit grows too, not just the money coming in. Now, one quick distinction, this is about the profit on paper, not the cash in your bank account. Those are two different things, and we're going to talk about the cash next. So the second one, is the cash actually showing up? This is the one Ben missed. You want to watch whether all that growth is really turning into money in the bank, or whether it's just piling up in that accounts receivable we talked about. A bigger and bigger stack of invoices you're still waiting to get paid on. Most accounting systems like QuickBooks give you a report that lays this out for you. It's called the Accounts Receivable Aging Report. All it does is show you who owes you money and how long it's been sitting there unpaid. 30 days, 60 days, 90 days and counting. And if you're not on a software like that, if you're tracking things through a spreadsheet, you can do the same thing by hand. Just keep a running list of who owes you and how long that invoice has been outstanding. That report is worth its weight in gold when you're growing because it answers the real question. Are you actually collecting the money you've earned? And are you following up on those invoices that are overdue? Growing revenue with cash that has never quite arrived isn't growth you can spend, it's just pressure. Now put those together and you can tell early what kind of growth you're in. If your net profit is climbing right alongside your revenue, not stuck flat when revenue jumps, and your customers are paying you in a timely manner, grow with confidence. You've earned it. If your revenue is climbing but your profit is flat, or the cash just isn't arriving, that's your early warning. It doesn't mean stop growing. It means fix the leak before you pour more through it. In plain terms, usually that means one of three things. Raise your prices so each job actually pays off. Get faster and firmer about collecting what you're already owed. Or get your costs under control. Do that first and then grow. Otherwise, you're just making the same problem bigger. You don't need to be an accountant to watch these two things. You just need to look at them. Is my net profit growing along with my revenue? And are my customers paying me in a timely manner so the cash is actually landing in my bank account? That's the difference between growth that builds your business and growth that breaks it. And what makes this all possible are books that are caught up and accurate. That's what lets you catch this pattern while there's still time to fix it, not after the cash is already gone. If you want a simple way to keep an eye on this, I built a free one-page scorecard that tracks the numbers we just talked about. What you actually keep, the cash you've got on hand, and your accounts receivable, that money still owed to you, all in one place, month to month. It's exactly the kind of thing that would have shown Ben the trouble early. I'll drop it in the description below. And if any of the numbers on it are new to you, don't worry. I've got other videos that walk through each one in plain English, and I'll link those below too. So before you chase your next big growth push, ask yourself two questions. Is my net profit growing along with my revenue? And are my customers paying me in a timely manner so the cash is actually showing up in the bank? If you answer yes to both, grow with confidence. If you can't, now you know exactly what to look for. And either way, you're deciding with numbers, not with hope. That's the real skill. Not just growing, but knowing whether your growth is healthy. It's the same skill behind every big call you make. Hiring, buying equipment, taking on debt. Read what your numbers are telling you, and the right decision gets a lot clearer. That's what this channel is about, and it's what we'll keep working on together. I'm Janie with Sturgeon Bookkeeping. Thank you so much for watching. I'll see you in the next video.